Okay, stop what you are doing and check the date. It is Saturday, February 7, 2026. If you have been watching the markets for the last 24 hours, frankly, I don't know how you've managed to sleep.
Sleep. It would be nearly impossible to sleep with what we're seeing on the charts. I mean, this is the kind of movement you wait a career for.
Hard to sleep, hard to look away, hard to even breathe. We are talking about a massive, violent, V-shaped recovery in the metals market.
hmm
Just yesterday, literally 24 hours ago, silver was sitting at $64. As of this morning, we have hit $78.
That's a $14 move in a single trading session.
Yeah.
In the world of equities, that's a good year. In the world of commodities, specifically silver, that isn't just a fluctuation. That is a repricing event. The BAM has broken.
That feels like it. It feels like the repricing has finally begun. And I know, sitting here looking at that number, $78 an ounce, there's this overwhelming urge to jump in.
Oh, absolutely.
The FOMO is absolutely visceral right now. You want to open the brokerage app on your phone, you see the green candles, you see the momentum, and your thumb is just hovering over that buy button.
And that is exactly where we need to hit the pause button, freeze frame. Because right now, amidst this euphoria, amidst this panic buying, millions of retail investors are about to make a fatal mistake.
A fatal mistake. You're seeing silver rip higher, you're seeing the dollar shake, and you're calling buying a mistake. That sounds, well, counterintuitive.
I'm not saying buying silver is a mistake. I'm saying how you buy it matters more than the price itself. If you log into your brokerage app right now and click Buy on SLV, the iShares Silver Trust, thinking you are helping the squeeze, thinking you are participating in this upside.
Right, which is what everyone is going to do.
Exactly. And you are metaphorically handing your gun to the enemy.
That is a vivid image. Handing your gun to the enemy, you're saying, I'm arming the people I'm trying to fight.
It's the reality. Buying SLV to squeeze the silver market is like trying to put out a fire with gasoline. You think you're dousing it because it's liquid, but you are actually fueling the very mechanism that suppresses the price. You are feeding the beast.
Okay, let's unpack this. Because SLV is the biggest ticker out there. It's the default. It's what everyone sees on CNBC. It's the first thing that pops up on Robinhood or E-Trade. If that's a trap, we need to understand why.
And that is the mission for this deep dive. We are going to put on our forensic accountant hats today. We aren't looking at charts. Charts tell you history. We're looking at the plumbing. The plumbing tells you the future. We need to conduct a forensic audit of this ETF trap.
So the central question is, are you buying a paper promise or are you actually draining the bar?
Exactly. We need to look at the authorized participant loophole, which is really the smoking gun here. We need to understand what I call the gym locker analogy, and we're going to really spend some time there because it explains everything. And we need to confront the massive financial barrier, what I call the whale barrier, that stands between you and your money in 2026.
Let's start with that forensic analysis of SLV. This is the big one, the iShares Silver Trust. Most people assume, I buy a share of SLV, I own a piece of silver. Simple. Transaction done.
And that is the assumption the banks rely on. They bank on your ignorance of the structure. But if you read the prospectus, and let's be honest, nobody reads the prospectus, which is why we are here, you realize that SLV is not silver. It is a trust unit.
Okay, define the difference for me. Because to my wallet, when I buy it, it looks the same.
Well, when you buy a share, you're buying a contract that tracks the price. But who creates that share? Where does it come from? That is where the authorized participant, or AP, comes in.
And the APs are usually the big boys, right? We aren't talking about a local credit union here.
Oh, the biggest. We are talking about massive bullion banks like JP Morgan, HSBC, the giants of Wall Street. They are the ones who facilitate the creation and redemption of baskets of shares.
So, I buy a share, the AP creates it. Does that mean they go put a corresponding amount of silver in a vault for me?
That is the trillion-dollar question, isn't it?
Yeah.
To understand the answer, we have to use the gym locker analogy. I think this is the best way to explain the concept of unallocated versus allocated accounts, and I want you to really visualize this place with me.
I love a good analogy. Walk me through the gym.
Okay, so imagine you join a high-end gym. Let's call it the SLV Fitness Center. There are 100 lockers in the changing room.
100 lockers, got it.
Now, you walk in with your gym bag. Your gym bag represents your investment, your silver. You walk up to the manager at the front desk to store your bag.
Okay, ready to work out?
In the SLV model, this is an unallocated system. The manager takes your bag. He doesn't give you a key. He doesn't point to locker 42. He takes your bag, and he throws it onto a massive pile of bags in a back room behind the desk.
So it's just a heap. My bag is in a heap with everyone else's.
It's a heap. and he hands you a paper ticket. You look at the ticket and say, hey, does this correspond to a specific locker? And he says, no. You have a claim on the volume of space a bag takes up. You have a right to a locker, but not a specific one.
So I don't have locker 42, I just have a claim check for 1 bag's worth of space. That's a weird way to run a gym.
It is. Now here is where the scam, or rather the business model kicks in. The manager is a smart guy. He looks at his data. He knows that historically on a Tuesday morning, only 10% of the members are actually in the gym at once.
Sure, makes sense. Not everyone shows up at the same time.
Exactly. So he looks at that pile of bags in the back room, and he thinks, I have 100 lockers, but I only ever have 10 people here. I can sell 500 memberships.
He's overselling the capacity. He's leveraging the space.
He is leveraging the space. He is betting that everyone won't show up at once. But it gets worse. He looks at your bag in the pile, and he sees a nice pair of running shoes sticking out.
Don't tell me he wears them.
He doesn't wear them. He rents them. Another guy comes in, let's call him a short seller, who forgot his shoes. The manager said, hey, I have a pile of bags back here. I can lend you these shoes for an hour.
He's renting out my gear without asking me.
It's called rehypothecation. In an unallocated account, the custodian, the manager, has the right to use the assets in the pool for their own operations. You are an unsecured creditor. You own a claim against the bank. You do not own the property itself.
That is terrifying, because if everything is fine, if it's just a normal Tuesday, I never know. I hand in my ticket, I get my bag, I go home.
Precisely. It works perfectly on a calm Tuesday. But today is Saturday, February 7, 2026. Silver is at $78. The gym is on fire. Everyone is rushing in at once to get their bags.
And the manager has 500 tickets out there and only 100 bags, or maybe even fewer because he's lent some out.
Exactly. He's insolvent. He locks the back door. That is a failure to deliver. That is SLV. It's an unallocated claim on a pile that is being used against you.
And this brings us to the authorized participant loophole. Because if they don't have to put a specific bag in a specific locker, what are they actually doing when I buy a share? Let's get technical for a second.
This is the trick. In a normal ETF, let's say a stock ETF for Apple, if you buy shares, the AP has to go buy the stock and put it in the trust. It's instantaneous. Asset for asset.
Right, 1 for 1.
But silver is heavy, it is slow, it has to be assayed, it has to be transported. So the SEC allows for exceptions. When you buy SLV, the AP creates a basket of shares, usually 50,000 shares at a time.
That's a big block of shares.
Huge block. Now, under unallocated rules, the AP doesn't necessarily need to deposit physical metal immediately to create that block of shares.
Wait, hold on. So they can sell me the share without putting the silver in the vault?
They can use substitutes. They can use lead silver. They could use paper credits. They could use what are called locational swaps in London. They essentially say, we owe the trust this amount of silver, and trust us, we're good for it.
It's an IOU. They're writing an IOU to their own fund.
Effectively, yes. That promise is enough to create the share that you just bought. But here is the gasoline argument I mentioned earlier. This is the part that should make every retail investor absolutely furious.
Hit me with it. How does my purchase hurt me?
Banks use the massive inventory of SLV shares as a stockpile to locate shares for shorting.
Explain that mechanism. How does my purchase help them short the market?
Well, when a big player, a hedge fund, or a bullion bank wants to short silver, they are betting the price will go down. To do that, they need to borrow shares to sell them into the market.
Okay, that's standard short selling. You borrow it, sell it, hoping to buy it back cheaper later?
Right. But where do they get those shares to borrow? They get them from the massive liquid pool of shares that is SLV.
So let me get this straight. I buy SLV because I want the price to go up. My purchase creates a share. That share is then put into this giant unallocated pool that the bank then borrows from to sell into the market, driving the price down against me.
Precisely. It is a closed loop. By buying SLV, you are adding liquidity to the very pool the banks use to suppress the price. You are absorbing demand. You think you are squeezing them, but you are just giving them more ammo to short with.
It's like buying bullets and handing them to the guy shooting at you.
That is why I say it's a fatal mistake. It absorbs demand rather than squeezing supply. If everyone buys SLV, the pile of paper claims grows. But the physical vault doesn't necessarily feel the pressure. The price on the screen might move for a bit, but the physical metal isn't being drained from the system.
And we have seen this movie before, haven't we? This isn't just theory. We have the receipts on this.
We do. Just look at the 2021 precedent. Remember the first big silver squeeze?
Vaguely. It feels like a lifetime ago. Reddit, GameStop, all of that mania.
During that squeeze, Billions of dollars poured into SLV in a matter of days. And what did SLV do? Did they go out and buy all the silver in the world? Did they drive the price to the moon?
No. The price crashed shortly after, as I recall.
And SLV quietly changed their prospectus.
I remember this now. Yeah, they added a warning line, didn't they?
They did. They added a clause effectively stating that they might not be able to source enough silver to back the shares. They essentially admitted the scarcity. They admitted they couldn't find the metal, but did they stop selling the shares?
No, of course not.
No. They kept selling the paper. That is the definition of a trap. They take your money, admit they can't get the product, and just keep the game running.
It's a confidence game. As long as nobody asks for the actual metal, the game continues.
And that is why, with silver at $78 today, in 2026, we cannot repeat that mistake. If you want to actually move the market, if you want to protect your wealth, you have to look at the plumbing. You have to look for the drain.
Okay, so if SLV is the trap, let's talk about the escape route. The source material points us toward PSLV, the Sprott Physical Silver Trust.
Right, and we need to be very clear here. This is not a commercial. I don't work for Sprott. We're doing a forensic audit. We need to see if the plumbing is actually different or if it's just a different brand of snake oil.
So what is the fundamental difference? Let's start with the structure.
It starts with the classification. SLV is an ETF, an exchange-traded fund. PSLV is a closed-end fund.
Why does that matter to the average person listening? I mean, that sounds like Wall Street jargon.
It matters because of how they handle cash. When PSLV raises cash, when you buy a share, they do not ask a bank for a paper favor. They do not do locational swaps. They have a very simple, direct mandate.
And what is that mandate?
They go into the commercial market and they buy 1,000-ounce industrial bars. Good delivery bars.
The big bricks, the ones you see in the movies, the heavy ones.
The big bricks, about 70 pounds each. And here is the key, the absolute key. They take those bars out of the COMEX ecosystem.
They physically move them, like on a truck.
Yes. They move them to the Royal Canadian Mint. They utilize armored trucks. They cross the border if needed. They put the metal in a distinct, secure location.
So going back to our visual, if SLV is a pipe that just loops back into Wall Street,
PSLV is a drain. Imagine two pipes. One pipe, the SLV pipe, takes your money, swirls it around in the derivatives market, and leaks sludge back into the system. The inventory stays available for the banks to play with.
and the other pipe.
The PSLV pipe drains into a secure container. For every $1 million that flows into PSLV, the physical vault of available silver for the markets gets smaller. There is less supply available for the banks to manipulate.
Because that metal is now sitting in a vault in Canada, locked up and accounted for.
Exactly. It creates a physical shortage. And in a commodity market, a physical shortage is the only thing that truly, permanently breaks the price manipulation. You cannot print a 1,000-ounce bar of silver. You have to mine it, refine it, and ship it.
Let's go back to the gym locker. If SLV is the messy pile of bags in the back room, what is PSLV?
PSLV is allocated. In our gym analogy, you walk in and the manager hands you a key. He says you are at locker 42.
A specific number, my locker.
A specific number. You walk to locker 42, you open it, and your bag is there. It is not in a pile. It is not being lent to the guy on the treadmill. It is yours. It sits there collecting dust, waiting for you.
And how do we know? Because trust is a dangerous word in finance. We trusted Enron. We trusted FTX. Why should we trust Sprott?
Verification. And this is a huge differentiator. SLV provides these opaque lists of total ounces. It's just a spreadsheet number. PSLV publishes a daily bar list.
A bar list? What does that mean?
A literal list of every single bar in the trust. That's the serial number, the refiner, whether it's Johnson Matthey or Heraeus, and the exact weight down to the decimal point. You can go online and download this list right now.
So I can theoretically scroll through and see, okay, there's bar number 88945 weighing 1,002.6 ounces, refined by Valcambi.
Exactly.
Yeah.
And it is audited by external inspectors who physically enter the vault to count the bars and check them against the list. It creates a chain of custody that simply doesn't exist with the paper products. You aren't taking their word for it. You are looking at the inventory.
That sounds solid. Pun intended. It sounds like the clear solution. But we are here to be forensic accountants, not cheerleaders. We have to look at the downside.
Absolutely. If we don't look at the risks, we aren't doing our job. And there are significant risks, especially right now with the price this high. This is not a risk-free play.
This is the part that really caught my attention in the notes, the whale barrier.
This is the crucial nuance. We talked about allocated storage locker 42, but here is the catch.
Yeah.
Can you, the listener, actually go to the Royal Canadian Mint, knock on the door, and ask for the contents of Locker 42.
I would assume there's a process. I'd have to fill out a form or something.
There is a process, but there is a barrier, a massive financial wall. To redeem your shares for physical metal, you need to meet a minimum threshold. That minimum is 10,000 ounces.
1,000 ounces.
10,000 ounces. That is roughly 10 of those massive 70-pound bars.
Okay, let's do the math on that, because that sounds like a lot of metal.
Let's do it. Today is February 7th, 2026. The price is $78 an ounce.
So 10,000 times 78. That's...
You need 780,000 US dollars worth of shares to redeem.
Whoa. Wait, say that again? 780 grand.
Correct. Nearly $800,000.
That's a house. That's not a trade. That's a mortgage in a nice city. That's a life savings for most people listening to this.
It is. It's a whale-sized position.
So for the regular guy listening who has, say, $50,000 invested, which is a lot of money, he's stuck.
Stuck is a strong word. He is invested, but he is not an owner in the physical sense. He cannot ring the bell and ask for his silver.
That feels like a massive rug pull clause in the fine print. Sure, it's allocated as long as you're a multimillionaire.
No, it's a logistical reality. You can't just FedEx a 70-pound bar to someone's mailbox. But you are right to be skeptical. If you have $50,000 or even $500,000 invested, you are still technically trapped in the paper price.
Explain that phrase. Trapped in the paper price.
It means you can sell your shares for cash. You can trade them on the NYSE, just like a stock. But you cannot convert them into metal. You cannot take delivery. So for the vast majority of investors, PSLV is still a financial instrument, not a physical possession.
That is a massive distinction. So you are draining the vault, yes. You are hurting the shorts, yes. But ultimately, you are holding a receipt unless you're a whale.
Correct. You are relying on the trust to hold the metal for you. You don't have the metal in your hand, in your possession.
And that leads us directly to the second risk, the location, the Royal Canadian Mint.
This is the Canadian Crown risk. The Mint is a crown corporation. It is owned by the Canadian government.
And we have some pretty recent history here that makes people nervous about that, especially given the last few years.
We do. We have to look at the context. Go back to 2022. The trucker protests in Ottawa.
Right. The Emergencies Act. I remember that clearly.
The Canadian government invoked emergency powers to freeze the bank accounts of people involved in the protests. It didn't matter if you were charged with a crime. If you were merely associated with the movement, your assets were frozen.
It was a huge wake-up call for a lot of international investors. It completely shattered the illusion that Western democracies don't seize assets.
Exactly. It proved that custody is political.
Yeah.
So the fear here is what happens in a real crisis, a systemic crisis.
The fear is a nationalization scenario.
You're right. If we are talking about a true currency collapse, which is often the entire thesis for holding silver, and the Canadian dollar becomes worthless, what does the government do?
They look at that massive vault full of silver sitting in Ottawa and they say, thank you very much. This is now a strategic national reserve for the good of the country.
Exactly, for the greater good. They invoke a clause, they pass a law, and suddenly your allocated silver belongs to the crown.
That is a chilling thought. So much for Locker 42.
If you hold PSLV, you are subject to the laws and the whims of the Canadian government. If you hold physical metal in a hole in your backyard, you are not.
That is such a necessary reality check. The old saying, if you don't hold it, you don't own it.
It's the oldest rule in the book for a reason. Possession is 9/10 of the law. In a crisis, it's 10/10.
There is one more risk we need to cover, and this one is more for the traders out there, the premium discount trap, because I know we have listeners who trade in and out of these things.
Yes, and this is why you will see day traders and prop firms specifically avoiding PSLV.
Yeah.
If you go to a professional trading desk, they are all trading SLV.
Why? If PSLV is supposedly better and safer, why would the professionals avoid it?
Because it is a closed-end fund. An ETF like SLV has that creation-redemption mechanism we talked about, that loop that acts like a thermostat. It keeps the share price glued to the spot price of silver.
So if silver moves 1%, SLV moves 1%. It's a perfect tracker.
Perfectly. It's mathematically tight. PSLV doesn't work like that. It trades like a stock. Its price is determined by supply and demand for the shares, not just the metal inside it.
So it can drift away from the underlying value?
It can drift significantly. It can trade at a premium, meaning you pay more than the silver is worth, or a discount, meaning you pay less.
Give me a scenario where this really hurts me as a trader.
Okay, let's say silver spikes up 2% in the futures market overnight. You are excited. You look at your PSLV shares at the market open, but maybe for whatever reason, sentiment on the stock market is cool that day. People are selling the fund to cover margin calls elsewhere.
So the metal is up, but my shares aren't.
Your shares might only be up 0.5% because the premium it was trading at evaporated. You didn't get the full move that you were expecting.
Ouch. That's incredibly frustrating.
Or the reverse. You buy in right now when everyone is excited. You pay a 5% premium because you're desperate to get in. Then the excitement fades, the premium collapses back to zero, and you lose 5% of your money, even if the price of silver stayed completely flat.
So SLV, for all its faults, is predictable for a trade.
SLV is a mathematically perfect tracker. It is designed for algorithms and options trading. PSLV has what we call premium risk. It adds a layer of volatility that traders absolutely hate.
This is where it gets really interesting for the listener, because we've painted a picture where neither option is perfect. One is a systemic trap for the market SLV, and the other has significant barriers and risks for the individual PSLV.
There is no perfect financial product. There are only tools. And you have to know which tool to use for which job. You don't use a hammer to turn a screw.
So let's break it down. We have the forensic evidence. We've looked at the plumbing. Now we need a verdict. We have, say, 3 categories of listeners. Let's tell them which vehicle fits their profile.
Right. Let's start with category A, the trader, the algo.
The guy looking at charts, playing options in and out in a day. He's looking at the 15-minute candles, not the 15-year outlook.
For this person, SLV is the tool.
Really? After all the trap talk, after the handing your gun to the enemy talk.
Yes, because the trader doesn't care about the long-term squeeze. He doesn't care about draining the vault. He cares about liquidity and perfect tracking. SLV is a casino chip. It is a betting slip. If you want to bet on the price moving for the next hour, you use the betting slip.
Just don't confuse the betting slip with the actual asset.
Exactly. Don't hold it overnight, don't hold it for the squeeze, and certainly don't think you are investing in silver. Use it for what it is, a synthetic tracking tool.
Okay, that makes sense. Now, category B, the squeeze investor.
This is the listener who wants to see silver go to $500 an ounce. This is the person who is angry at the banks. The activist investor.
The one who wants to break the wheel. The person this movement is all about.
For them, it has to be PSLV.
Because of the drain mechanic.
If your primary goal is to break the manipulation, you must drain the physical bars from the system. You have to accept the volatility. You have to accept the premium risk because your capital is being used as a weapon to reduce physical supply.
So you're basically paying for the privilege of hurting the shorts.
That is a very good way to put it. You are accepting those risks to ensure the vault is being drained. You are taking bars away from the COMEX.
And finally, category C, the owner.
This is the person listening who says, I don't trust Canada, I don't trust the internet, I don't trust the power grid, and I certainly don't trust a bank or a brokerage account.
The ultimate safety seeker, the prepper, the historian who knows what governments do in a crisis.
For them, there is only physical.
Physical in hand, in your own possession.
Physical in hand. No counterparty, no whale barrier. You don't need $780,000. You just need enough to buy a 1-ounce coin.
It's the hierarchy of safety, isn't it?
Think of it like a ladder. At the very top, the safest rung, you have physical in hand. That is the gold standard, pun intended.
Right.
Below that, you have PSLV allocated trust, safer than most, but subject to that whale barrier and government risk.
Right.
Below that, maybe you have mining stocks for leverage and risk.
Right.
And at the very bottom, in the mud,
The trap.
SLV, the paper promise, the unallocated swamp.
So, as we look at this V-shaped recovery, as we see $78 on the screen today, February 7, 2026, the question you have to ask yourself is, what are you actually trying to achieve with your money?
Are you trying to make a quick buck in a casino? Or are you trying to own a piece of the future?
It really comes down to that distinction between an asset and a liability.
That is the 2026 filter. Every time you buy something, ask yourself, is this an asset I truly own, or is this a liability of a counterparty that I'm holding?
An SLV is a liability of the custodian.
PSLV is an asset held in trust for you, with conditions.
And physical is just yours.
Physical is truth. It doesn't need electricity. It doesn't need a prospectus. It just is.
I love that. Physical is truth. You know, we started this by saying that buying SLV is like handing your gun to the enemy.
It is.
So the provocation for the listener today is this. If you are going to fight the Fed, if you are going to fight this decades-long market manipulation.
Bring a spear, not a sponge.
Bring a spear, not a sponge. I like that. SLV is the sponge. It soaks up your energy, it soaks up your capital, and it changes nothing fundamentally.
And PSLV and physical is the spear. It pierces the veil.
And right now, at $78, the market is incredibly vulnerable to the spear. The sponge just keeps the game going. The banks love the sponge. They fear the spear.
It's a fascinating moment in history. We might look back at this weekend as the tipping point. The weekend the repricing became real and irreversible.
But only if the capital flows into the right pipe. If everyone piles into SLV tomorrow, the price will crash by Wednesday. If everyone drains the vault, the price goes vertical.
We have unpacked the gym locker, we have exposed the authorized participant loophole, and we have calculated the whale barrier. The rest is up to you.
It's your money. Make sure it's actually yours. Before we sign off, I want to tease the next step in this forensic investigation, because if you think the ETF trap is scary...
Oh, we haven't even touched the ultimate trap yet. Not even close.
We are talking about central bank digital currencies,
Yeah.
CBDCs, and what's being called the 2026 banking lockup.
That is where they close the exit doors completely. That is where unallocated becomes the only option allowed by law.
We will be diving into that nightmare scenario in the next deep dive. You do not want to miss it.
It connects all of these dots.
But for today, decide where you stand. Are you holding the paper tiger or the real deal?
The future belongs to the owners.
Thanks for listening to The Deep Dive. We'll see you in the vault.